Good morning. Today we are going to talk about interest rates and bond valuation. This chapter is divided into two main parts. The first one is related to interest rate fundamentals and determination. And the second part is related to bond and its valuation. Let's start with the first part, which is interest rate fundamentals. What's interest rate and what is the required rate of return? Interest rate is usually applied to debt instruments. Such as loans, bank loans, and bonds. It is from the point of view of the borrowers, it is considered to be cost of borrowing. And from the point of view of the lenders, it is the compensation paid by the borrower. What is the required return? Required return is related or applied to equity instruments. Such as common stock. It is the cost of funds obtained by selling an ownership interest. Interest rate determination, or the equilibrium interest rate. How interest rate is determined in the market? Interest rate is determined based on demand and supply forces. Interest rate is considered to be the price of the commodity, the price of the funds that you are going to get. So it's determined based on demand for fund and supply fund. So this figure shows the market for funds. This is funds, demand and supply. And this is the real interest rate. It's determined at the point of intersection of demand and supply. Actually, it's supply of savings or supply of funds. so they are the lenders, and demand for investment fund, or they are the borrowers. So this is lenders side and this is borrower side. Point of intersection of demand and supply is point of equilibrium in this market, at which we have to identify the quantity or the amount of fund that will be borrowed or invested, and the equilibrium interest rate that will prevail in the market. So it is determined based on demand and supply forces. Just like any commodity, demand curve is negatively sloped, as there is a negative relationship between price of a commodity and the quant demanded of this commodity. Actually, price of our fund is the interest rate, so there is a negative relationship between the interest rate and the borrowed amount of money. Okay, so this is the demand side. The same with respect to the lender side or the supply side. There is a positive relationship between price of this commodity and the quantity supplied of this commodity. Price of funds is the interest rate. So from the point of view of lenders, as interest rate is going to increase, they would like to supply more and more funds. This relationship is going to hold ceteris paribus or keep all other factors constant. So equilibrium, interest rate, will be determined at the point of intersection of demand and supply for funds in a perfect world, or in a world without inflation, no liquidity preferences, no risk. This is the perfect world. Actually, if there is any change in the economic conditions or tastes or preferences, economic conditions will affect risk or inflation rate. So the equilibrium point is going to change, and the demand and supply curve is going to shift. So what are the factors that can influence the interest rate? As we said, that there are three main factors: inflation, which means an increase in the general price level. Number two, risk. Risk leads investors to expect a higher return on their investment. So this means that the higher the risk, the more the required return on your investment. And number three, liquidity preferences, which refers to the general tendency of investors to prefer short-term securities. So here we have to differentiate between nominal interest rate and real interest rate, or in other words, nominal or actual interest rate and real interest rate. What's nominal interest rate? Nominal interest rate is the actual rate of interest charged by the supplier of funds and paid by the demander. Nominal interest rate differs from the real interest rate as a result of two factors. Number one, expected inflation. As you expect that inflation rate is going to increase, so this should be reflected in an inflation premium. And number two, risk. Issuer and issue characteristics such as default risk or contractual provisions as reflected in risk premiums. So nominal interest rates which is R1 can be given by the following equation. R1 equal R star plus IB plus RB1, where IB is the inflation premium, RB is the risk premium, and R star is the real interest rate. Okay, once again, this is real interest rates. Inflation premium, risk premium. Or we can write it as the summation of real interest rate and the IB or inflation premium is risk-free rate. Risk-free rate. So this is the interest rate without risk, or RF, and risk premium. So we can write it as R1, which is the nominal interest rate, is the summation of risk-free rates plus risk premium. Or in other words, nominal rate consists of two main components: a risk-free rate of return and risk premium. For a moment, just ignore the risk premium. So this means that risk-free rates is the real interest rate plus the inflation premium. So the more inflation is expected, the higher the inflation premium and the higher the nominal interest rate. Okay, once again, the higher the expected inflation, the higher the risk premium, and the higher the nominal interest rate. Let's take an example. X has $10 that he can spend on candy costing $0.25 per piece. He could buy 40 pieces of candy, $10 over 0.25 today. The nominal interest rate on a 1-year deposit is currently 7%, and the expected inflation rate over the coming year is 4%. If X invested the $10, how many pieces of candy could he buy in 1 year? In 1 year, X would have 1 plus 0.07, which is the interest rate, multiplied by $10. If he is going to invest or deposit this money in bank, he is going to get 10 plus the interest rate, or the principal plus the interest. The principal is 10 and the interest rate is 0.07 out of 10. So actually he is going to get 1 plus 0.07 multiplied by 10, which is $10.7. This is in 1 year. Due to inflation, one piece of candy would cost 1 plus 0.04 multiplied by 0.25. So it's 0.26. This is due to inflation. As a result, X would be able to buy 10.7 divided by 0.26, which is 41.2 pieces. So this means that there is an increase by about 3% in the buying power. Which is reflected by an increase in real rate of return, or there is it is due to the differences between the interest rate and the inflation rate. So once again, X is going to buy candy. The cost of each one of them is $0.25. He is going to buy 40 pieces for $10. And instead of spending this money today, he is going to invest the $10 for 1 year and get 7% interest rate in return. And after that, he is going to use the money, principal plus interest, in order to buy the candy, given that the inflation rate is 4%. So the first step, we have to calculate the amount of money after 1 year, or the cash flow of money after 1 year. So it's calculated as the principal, which is 1, plus the interest rate, which is 0.07 multiplied by the $10. So it's 10.7. And then due to inflation, the price of the one piece of candy will be 1 plus 0.04, which is the inflation rate, multiplied by 0.25, which is the price in this year. So the price will be 0.26. Then we have to calculate the number of units that he can buy, which is 10.7 divided by 0.25, or 0.26, sorry. So it will be 41.2. So there is an addition about 1.2 units that he can buy due to an increase in or the difference between nominal interest rate and real interest rate. Now let's move to the second part of this chapter, which is corporate bonds. Or what's bonds? A bond can be defined as long-term debt instrument indicating that the corporation has borrowed a certain amount of money and promises to repay it in the future under clearly defined terms. So it's just like a promise to pay a certain amount of money, which is a borrowed amount of money, that has a par value or face value and coupon interest rates and maturity dates So what's the coupon interest rate? Coupon interest rate is the percentage of the bond's par value that will be paid annually or semi-annually. So say for example it's 10%, so it's actually 10% of the par value or the face value. Let's assume it is 1,000. So annually the bondholder is going to get 1,000 multiplied by 10%. Okay, so this is the coupon interest rate. The par value or the face value can be defined as the amount borrowed by the company and the amount owed to the bondholder on the maturity date. The maturity date is the time at which the bond becomes due and the principal must be repaid. So these are the main components of any bond: par value, interest rate or coupon interest rate, and maturity date. Cost of bonds to the issuer. In general, the longer the bond's maturity, the higher the interest rate. The larger the size of the offering, the lower will be the cost of the bond. The greater the default risk, the higher the cost of the issue. And finally, the cost of money in the capital market is the basis for determining if a bond's coupon interest rate. So these are the factors that affect the coupon interest rate, or actually the cost of bonds with the issuer. Number one, maturity. The higher the maturity, the higher the interest rate. Number two, the size of the offering. The larger the cost will be lower. And number three, the higher the risk, the higher the cost. And number four, finally, the cost of money in the capital market. So these are the main four factors that affect cost of bonds to the issuer. Bond deals. Bond deals. There are three main cited yields. Number one, current yield. Number two, yield to maturity. And yield to call. In the next part, we have to talk about the three different types of yields. Let's start with bond price in order to be able to understand what's current yield. Bond prices. Almost all corporate bonds are issued with a par value or face value of $1,000. All bonds are quoted as a percentage of par. So for example, a $1,000 bar value bond quoted at 94.007 is priced at $940.07. So this is calculated as the $1,000 multiplied by this ratio, which is 94.007. Corporate bonds are quoted in dollars and cents. Thus, company C price of 103.143 for the day was 1,031.43. So we can determine the price of any bond as the quoted value multiplied by $1,000 in order to determine the price of the bonds. Let's take an example for number of companies, and this is coupon, maturity, price, and yield to maturity. This is company A, B, C, D, and E. 6.125%, 7.2, 5.15, 5.85, and maturity November 15, 2011, October 31, 2036, Jan 15, 2014, Jan 15, 2017, Jan 14, 2012. Price 105,336, 43007, 103,143, 95.140, exactly 100.876. Yield to maturity. Yield to maturity, year number case company A, it's 4.788, 6.4, 6.606, 5.814, and 5.613. So we can define yield to maturity as the rate of return that investors earn if they buy a bond at a specific price and held it until maturity. So this is the return if the bond is held up to the maturity date. Okay. Valuation of bonds. Valuation fundamentals. What's valuation? What's meant by valuation? Valuation is the process that links risk and return to determine the worth of an asset. There are three key inputs to the valuation process. Number one, cash flows. Number two, timing. And number three, a measure of risk, which determines the required return. So it has three main components or three main elements. Number one, cash flows. Number two, timing. And number three, a measure of risk. The value of any asset is the present value of all cash flows that's expected to provide over the relevant time period. So the value of any asset say for example V note can be expressed as cash flow at time 1 divided by 1 over R, which is the appropriate rate of return of the discount rate to the power 1 plus cash flows in year 2 divided by 1 plus the discount rate to the power 2, etc. plus CF to year n 1 plus R to the power n, where F note is the value of an asset at time 0, CF is the cash flows, and R is the discount rates in relevant time period. Say for example, if you are going to buy a stock in any company and you expect to receive cash dividends of $300 per year, and the expected discount rate is 0.12. So once again, example, you are going to buy stock, you are going to buy securities that they are going to yield $300 per year, and the discount rate is 12%. So in this case, the value of this security will be 300 divided by 0.12, which is 2,500. Another example, If you expect to receive a cash flow of 2,000 at the end of year 1 and 4,000 at the end of year 2 and 10,000 at the end of year 4, so in this case, if you would like to calculate the price of this asset, it will be and if you know that the required return is 20%, so it will be 2,000 divided by 1 plus 0.2 to the power 1 plus 4,000 over 1 plus 0.2 to the power 2 plus 10,000 over 1 plus 0.2 to the power 4. So it will be 9266.96. This is the case of any asset. So now let's talk about bond valuation itself. In case of bond valuation, as we said before, bonds are long-term debt instruments used by businesses and the government to raise large sums of money from different groups of lenders. Most bonds pay interest semi-annually at a stated coupon interest rate, have an initial maturity of 10 to 30 years, and have a par value of $1,000 that must be paid at maturity. In case of bond valuation, the value of bonds which is B note will be determined by B note equal I multiplied by summation from T equal 1 to N 1 over 1 plus RD to the power T plus M multiplied by 1 over 1 plus RD to the power N, where B note is the value of the bond at time 0. I, annual interest rate. N is the number of years to maturity, and M, bar value in dollars. RD is the required return on bond. Example: Mills Company, large defense contractor, on January 2007 issued a 10% coupon interest rate, 10 years bonds with a $1,000 bar value that pays interest semi-annually. So if you would like to find the value of these bonds, so first of all, investors who buy this bond receive the contractual right to two cash flows: 100 annual interest rates, interest, which is calculated as 10 multiplied by 1,000 bar value. This is going to be distributed as 50 and 50, as it's a semi-annual payment. Okay, and at the end of the 10 years you are going to get $10,000, $1,000, assuming that is the Mills company bond issue is paid annually, and that the required return is equal to the bond's coupon interest rate. So I will be $100. RD is 10%, as the required is equivalent to the coupon interest rate, and M is $1,000, and the N is 10 years. So this means that we have to calculate So this company is going to receive $100 for 10 years, in addition to $1,000 in the 10th year. So for year 1, it's 100. And for year 2, 100, for year 3, 100, etc. For year 10, it will be 1,100. So in this case, if you are going to substitute in our law, B node equal I multiplied by summation 1 over 1 plus RD to the power T, it will be $614.46 plus the second part, which is M multiplied by 1 over 1 plus RD to the power T, it will be 300 $85.54. So the summation will be 1,000, which is equivalent to the face value or the par value. So in practice, the value of a bond in the market is rarely equal to its par value. This is just the case if coupon interest rate is equivalent to the required rate of return. So in this case, if required return equal coupon interest rate, value of bonds or price of bonds will be equivalent to the face value. And this is not the situation in the real market, or rarely happens in the real market. Why? Because of economic changes such as inflation or any economic disturbances, increase in growth rate or decreasing growth rate, which will affect any other factor in the market. Okay, and number two, risk. These factors will cause a change or a difference between required return and the coupon interest rate. So if you calculate the bond value, let's assume that we have the general situation, a bond $1,000 face value and 10 years, 10% coupon interest rate, and the required rate of return is 12% in one case, 10% in one case, and 8% in one case. As a result, if you calculate the bond value in the first case, it will be 887. So this means that the bond value is discounted. If it is 10, it will be 1,000. So it is the bar value. If it's 8%, it will be 1,134. So there is a premium in this case. So from this we can conclude that if the required rate of return is equivalent to the coupon interest rate, the bond value will be equivalent to bar value. If the required rate of return is greater than the coupon interest rate, the bond value will be discounted. And if it is lower than the coupon interest rate, the bond value will have a premium. Will have a premium. So this means that there is a negative relationship between required rate of return and bond value. The higher the required rate of return, the more discounted the bond value, and vice versa. So this means that the year to maturity, as we said that the yield to maturity is the rate of return that investors earn if they buy a bond at a specific price and hold it until maturity. The yield to maturity on a bond with the current price equal to its bar value will always equal to the coupon interest rate. So this means that if the current price equal bar value, this means yield to maturity is equal coupon interest rate. If the bond value differs from bar value, the yield to maturity will differ from the coupon interest rate. This is the end of our lecture. Thank you.